Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing MGC Pharmaceuticals stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. MGC Pharmaceuticals is a biopharma company with a nature to medicine strategy. It's at the forefront of the phytocannabinoid market. Phytocannabinoids are cannabinoids that occur naturally in a cannabis plant. The company is headquartered in Australia and was founded in 2005. It went public in 2012 and trades on the Australian Stock Exchange, Pink Sheets, London Stock Exchange, and Deutsche Börse. It has a patent pending for its drug that treats multiple ailments, including viral infections with acute and chronic inflammation. It also treats COVID-19 and variants of the flu, autoimmune diseases, adverse events from cancer therapy, and the promotion of an immune response to bacterial, viral, fungal, and parasitic infections. It has a pipeline of phytocannabinoid-derived medications with multiple products currently being prescribed to patients and products in clinical development and testing. The company does have low sales, but if it can develop quality patents and medications, then it can sell or license those items in the future. But I do believe the ideal situation is they become an acquisition target for a larger company. Let's get started with the model. This is a micro cap company, 114 million market cap. They're trading at 5 cents a share and they have 2.3 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. You can see they have negative free cash flow each year since their revenue is so low. Net income is the profit and loss on the income statement. It's revenue minus expenses. That's also negative each year. Revenue is the sales for the company. That's pretty low, $1 to $2 million a year. We're looking at the ticker that trades on the Australian Stock Exchange, so all the numbers in this video are in Australian dollars. This is the company's income statement. The top line is the revenue, the sales. They had their most revenue in 2020 at 2.1 million. It was 1 million in the trailing 12 months. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit. And they had the highest gross profit in 2019 at 300 million. Then below that is operating expenses. And their operating expenses are higher than their gross profit, so they have negative operating income each year. In the trailing 12 months, they paid $385,000 of interest on their debt, which is the most they paid any year. Below that is other income and expenses. These are usually asset impairments. Then the bottom line of the income statement is their net income, which is negative every year. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And they have negative free cash flow each year. So they mainly run their business on capital stock. They issued 5 million of stock in 2018, 35,000 in 2019, and 11.4 million in 2020. Every time a company issues capital stock, that increases the shares outstanding, making your shares less valuable. Most companies that have low revenue don't take on debt because they can't get good terms, plus they're going to have difficulty paying the interest payments on their debt. Let's look at the capital structure. They have 3 million of equity, 2 million of debt. They're 62% equity, 38% debt. Their net debt is 0, so they can pay off all the debt with the cash on their balance sheet. Their WACC is 10.5%, and that's a discount rate we're going to apply to the future cash flows. We estimated 7 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 7, that's 512 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $249 million. We divide that by 2.3 billion shares. And we get a calculated stock price of 11 cents. They're trading at 5 cents, so they're trading at a 54% discount. It is a buy according to the model, but it's really hard to value this company. I predicted their 2027 revenue would be $400 million, and they would convert 10% of that into free cash flow. And their free cash flow in prior years just backed into that $40 million. This top chart is the stock price since it started trading. So it looks like when it started trading, it was at its highest at over $3 a share. Then it came down really quickly the first year, and it looks like it was flat after that, but it's really hard to tell on this chart. This chart is the stock price in the past year. So it looks like it was flat for several months. Then the price was driven up to past 11 cents a share. Then it came down to 5 cents. Sometimes when there's good news about a company, their stock price gets driven up. Then when there's no good news for a while, the stock price comes back down. People take their gains and sell off their stock. Their beta is 1.65, so the stock moves about 1.5 times the market. The stock went up 96% in the past 52 weeks, while the S&P 500 went up 40%. The 52-week low was 2 cents, the high was 13 cents. And the stock is trading above its 200-day but below its 50-day moving average. About 7 to 10 million shares are traded each day on this stock. Of the 2.3 billion shares outstanding, 1.6 billion are on float, and only 0.25% of the shares are held by institutions. In the past year, this stock has gone up 96%, while its industry went down 8% and the market went up 36%. In the past 3 years, this stock has gone down 31%. Its industry did even worse, down 45%, while the market was up 32%. In the past 5 years, this stock has gone down 12.5%, its industry 40%, and the market is up 65%. In the past 5 years, their annual earnings decreased 22%, while its industry increased 36% and the market increased 12.5%. In the past year, their earnings increased 27%, its industry 16.5%, and the market 6%. The biggest shareholder is the founder at 2.3%, then Premier Fund, George Boucher, and then 2 other executives at the company. Let's look at their financial ratios. The average PE in the market is 33, the median is 22. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so we can't look at the PE. Their price to sales is 109, so investors are paying $109 for $1 revenue. That's a really bad price to sales ratio. Their price to book is 36.7. They have negative EBIT, so they have negative return on invested capital, negative interest coverage ratio, negative ROE. They do have a good current ratio of 1.1, so they can cover their current liabilities with their current assets. They seem to be undercapitalized because they had negative $12 million of free cash flow and no working capital, so they're going to be short $12 million. So it looks like they're going to do another capital raise and dilute the shareholders to get more funding to run their business over the next 12 months. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 18 companies in the same industry as MGC, and MGC is worse in every single category. That's why all their numbers are in red. So to summarize, I have them trading at a 54% discount, but this can be a really risky stock because if this company can't do another capital raise, it might go out of business. The best bet is they get acquired by a bigger company and then your stock price could go up 50% overnight. Of course, a lot depends on the success of their patents and their medication. I rank their free cash flows 1 out of 10, their revenue 1 out of 10, and their ratios 1 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.